Liquidity matters more than status, and cash flow matters more than appearances. In real financial terms, the people who are actually ahead are usually the ones who can survive bad markets, stay invested when conditions change, and make decisions without being forced by debt, panic, or short-term needs. So if you want to know whether you are financially ahead of everyone else, you do not look at visible consumption, and you do not look at isolated wins. You look at the structure underneath the life. Let's get precise. The first sign you are financially ahead is not that you make more money than everyone around you. It is that your financial life is not fragile. You have liquidity, controlled fixed expenses, and enough margin between income and spending that a bad month does not turn into a financial emergency. That matters because markets do not reward optimism alone. Markets reward endurance. The person with a strong balance sheet can hold quality assets through volatility, add when prices get cheaper, and wait for compounding to do its work. The person without liquidity has to sell into weakness, borrow at bad terms, or stop investing exactly when expected future returns are getting better. You need to understand how the machine works. Asset prices move because expected cash flows are constantly being repriced by interest rates, liquidity conditions, volatility, and positioning. In other words, the market is not just reacting to what an asset is. It is reacting to what it may earn, how risky those earnings are, what interest rates are doing to the value of those earnings today, how much capital is available, and how other participants are already positioned. That is the operating mechanism. The financial equivalent of a biological mechanism is pressure and response. When liquidity is abundant, risk assets can keep climbing because more capital is available to chase future growth. When rates rise, long-duration assets become more sensitive because distant cash flows lose present value. When volatility expands, leverage becomes more dangerous, weak hands exit, and price can disconnect from narrative faster than most people expect. If you are financially ahead, you are built to survive those environmental shifts. That is why liquidity is the first real signal. If your emergency reserves are solid, if your fixed obligations do not consume your future options, if your debt structure is manageable, and if your savings behavior is automatic, you are ahead even if your lifestyle does not look impressive. Most people misunderstand this because they confuse income with resilience. A high earner with no cash buffer, heavy fixed expenses, and lifestyle inflation is financially exposed. A moderate earner with disciplined saving, low financial drag, and a strong cash position has control. Control is what matters. Control lets you stay rational when the environment gets hostile. So apply this practically. If your income is unstable, you increase cash reserves before increasing risk exposure. If your job is cyclical, you keep more months of essential expenses than someone with stable salary income. If markets drop 20% and your reserves are intact, you do not react by liquidating productive assets. You react by checking whether your original thesis is still valid, whether your time horizon has changed, and whether valuations have improved enough to justify continuing contributions or modestly increasing them. If markets rise sharply, but your cash buffer is weak, you do not chase. You repair the foundation first. If your monthly obligations exceed what your income can comfortably absorb, you reduce financial fragility before you start pretending you are building wealth. That means lowering fixed costs, restructuring debt where possible, and protecting liquidity. This is not defensive thinking, it is strategic thinking. You are creating the ability to stay in the game. The second sign you are financially ahead is that your money has a repeatable system, not a mood. You are not relying on bursts of discipline, sudden inspiration, or market excitement. You have a controlled process for saving, allocating, reviewing, and rebalancing. That puts you ahead because wealth usually comes from repeated good decisions under average conditions, not from one spectacular decision under ideal conditions. Most investors want to feel smart. Financially strong people want to be systematic. Again, the market mechanism matters here. Prices are influenced by momentum, earnings revisions, liquidity flows, and positioning. That means price can move for reasons that have nothing to do with your personal story about the asset. If you do not have a system, you will interpret movement emotionally. You will confuse rising price with proof, falling price with failure, and temporary noise with information. But if you are financially ahead, you allocate with a framework. You know what percentage of income gets saved. You know what portion goes to short-term reserves, what portion goes to long-term investments, and what portion, if any, is allowed for higher risk ideas. You know your maximum position size. You know how often you rebalance. You know what would make you reduce exposure. That structure is a competitive advantage because it prevents you from improvising when the environment becomes unstable. Here is how you use that. You automate your base contributions, so saving happens before lifestyle expands. You separate capital by time horizon. Money needed within 1 to 2 years does not belong in volatile assets. Money with a 5 to 10-year horizon can accept more equity risk because time absorbs some volatility. If the market moves up rapidly on expanding optimism and narrow leadership, you do not automatically increase exposure. You first ask whether breadth supports the move, whether valuations remain reasonable, and whether your current allocation is already sufficient. If the market corrects sharply, but the long-term drivers remain intact, you continue scheduled buying rather than treating lower prices like a signal of failure. If a single position grows too large, you trim or rebalance according to rules rather than ego. If rates rise and liquidity tightens, you do not assume all winning strategies still work. You review duration risk, credit risk, and your exposure to assets dependent on cheap capital. This is where most people stop, but this is the advanced level. Once your system exists, you start reading second-order effects instead of first-order headlines. A rate increase is not just a higher number on a screen. It affects mortgage demand, refinancing pressure, startup funding, consumer spending, equity multiples, and bankruptcy probability for weak balance sheets. A market rally led by a few names may feel strong, but weak breadth can signal fragility beneath the surface. A falling asset is not automatically a bargain. If liquidity is evaporating and forced selling is increasing, lower price may mean higher risk, not better value. Correlation breakdown matters too. In calm periods, people assume diversification will behave politely. In stressed conditions, assets that looked independent can suddenly move together because liquidity and fear become the dominant drivers. If you are financially ahead, you respect those regime changes. You understand that a portfolio is not diversified just because it contains different tickers. It is diversified only if the underlying risks are meaningfully different. You understand that leverage does not merely amplify returns. It amplifies the probability of permanent damage. Bankruptcy risk is not linear. Once you cross certain thresholds of debt service pressure and falling cash flow, outcomes can deteriorate very quickly. That is why oversized positions, borrowed confidence, and emotional averaging down are so destructive. A 50% drawdown requires 100% recovery just to break even. That is arithmetic, not opinion. So when the environment changes, you change behavior before the damage compounds. Now, the third sign you are financially ahead is that you think in timeframes and probabilities, not in stories. Most people are trapped in narrative. They buy what feels exciting, they sell what feels uncomfortable, and they evaluate every decision too early or too late. But when you are ahead, you know exactly what game you are playing. You know whether a position is tactical or long-term. You know what information matters over the next month versus the next decade. You know that the same asset can be attractive in one time frame and dangerous in another. That changes everything. If you are buying a broad market index for long-term wealth accumulation, short-term volatility is not the same kind of signal as it would be for a short-term trade. If you are taking a tactical position around a catalyst, then entry timing, liquidity, and exit discipline matter much more. If inflation is sticky and rates remain elevated, you do not blindly pay any price for distant growth. If recession risk is rising, you review balance sheet strength, cash generation, and sensitivity to funding costs. If the market is euphoric, you reduce the temptation to extrapolate. If the market is fearful, you separate solvency problems from pricing dislocations. This is how financially advanced people behave. They identify the time frame, define the risk, size the position, and act according to probability rather than emotion. Most investors misunderstand this because they copy behavior without copying context. They hear buy the dip without understanding liquidity. They hear long-term without understanding whether they personally can remain long-term under pressure. They hear diversification without understanding concentration in hidden factors. And they hear hold without understanding the difference between temporary volatility and permanent impairment. That is why being financially ahead is not a vibe. It is a set of decision advantages. So walk it through like an operator. Suppose markets fall 15% in 6 weeks. If your emergency fund is strong, your income is intact, and your asset allocation was built for a multi-year horizon, your reaction is not panic. Your reaction is review. You check whether this is valuation compression, earnings deterioration, liquidity stress, or a combination. You ask whether the assets you own still fit the original case. You continue planned contributions. Maybe you rebalance if equities have fallen far enough below target weights. But you do not convert volatility into self-inflicted damage. Now suppose markets are screaming higher. Social media is full of easy money stories, and your speculative watch list is up faster than your diversified portfolio. If you are financially ahead, you do not mistake underexposure to mania for failure. You check position size. You check concentration. You check whether you are being paid for the risk you are taking or simply joining momentum late. If you choose to take tactical risk, you cap the size so that one wrong decision cannot set back your year. You define the exit before entry. You decide in advance what invalidates the trade. That is the difference between using risk and being used by it. Suppose your income suddenly weakens. This is where the real test appears. If you were ahead only on paper, the pressure will expose it quickly. But if you were truly ahead, you will have options. You may slow new investments temporarily, but you do not need to liquidate everything at a bad time. You may cut discretionary spending without touching core stability. You may shift toward more liquidity without abandoning the long-term framework. Optionality is one of the clearest signs of real financial strength. It means your future has not been pre-sold to support your present image. To develop this level of control, you need a deliberate practice process. Track your savings rate, liquidity coverage, investment contributions, debt service burden, and portfolio concentration every month. Journal every meaningful decision before you act. Write the thesis, the time frame, the size, the risk limit, and the conditions that would make you change your mind. Then reverse test it. Ask what would need to happen for this decision to fail badly. Ask whether that scenario is unlikely or merely inconvenient to think about. Run simple simulations. What happens if your income falls 20%? What happens if your largest position drops 35%? What happens if your safe assets are less liquid than expected? What happens if correlations move toward 1 during stress? These questions are not pessimistic. They are the training ground for composure. You maintain the skill with evaluation loops. Review your numbers monthly. Review your asset allocation quarterly. Review your spending behavior every 90 days because lifestyle creep hides in ordinary months. Measure what matters: savings rate, months of liquidity, percentage of income committed to fixed expenses, investment rate, concentration risk, and error frequency. When you make a mistake, do not only record the financial cost, record the process failure. Were you too early, too large, too emotional, too dependent on one assumption, too lazy about liquidity, or too vague about time frame? The lesson is usually not inside the outcome alone. It is inside the process that created the outcome. Combine this with other tools so your judgment gets sharper. Use valuation to decide what price implies. Use macroeconomics to understand the environment that surrounds that price. Use technical analysis to observe how participants are actually behaving in real time. Use risk management to ensure that even a correct idea cannot destroy you if executed badly. None of these tools should dominate on their own. The edge comes from integration. Valuation without macro can trap you in cheap assets that stay cheap under tightening conditions. Macro without technicals can make you early and ineffective. Technicals without risk management can make you reactive and overconfident. Risk management without a thesis can make you safe but directionless. When you combine them correctly, you stop acting like a spectator and start acting like an allocator. Then test yourself under pressure. Use virtual trading to rehearse execution and observe your emotional biases. Use small real positions to see whether your behavior changes when actual money is involved. Do pre-trade risk analysis before anything outside your standard plan. Stress test your decisions when headlines are loud, not when the room is calm. The goal is not to become fearless. The goal is to become stable enough that fear does not write your plan for you in real time. So if you want the clean answer, the 3 signs are these. Your finances are resilient, your money runs through a system, and your decisions are based on time frames and probabilities instead of stories. That is what it looks like to be financially ahead of everyone else, even when nobody can see it from the outside. Real advantage is not louder, it is calmer. It is being able to keep compounding while others keep resetting. And here is the detail worth replaying, because it is where the whole script quietly turns. The people who look ahead in good conditions are often not ahead at all. The real separation only appears when liquidity tightens, volatility rises, and time horizon gets tested. That is the moment when you find out whether your wealth is a performance or a structure.